This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
All right, let's dive into that deck. Eric, we're going to start with crude oil here. How did those EIA inventory numbers come in?
EIA inventory printed a build of 1.2 million barrels, which is a significant build, but compared to the last 8 weeks, which were just huge builds, it was benign in comparison. Cushing, Oklahoma building 307,000 barrels, gasoline drawing down 874,000 barrels, distillates building 179,000 barrels. U.S. production unchanged at 12.3 million barrels. Tape action was up after a smaller than expected build, but really not that much immediately after inventory. However, early Thursday morning, we are seeing further strength to getting back above $78. The real test, though, is up at 80.38, which is the 100-day moving average on the continuation WTI contract. So I'm not placing any bets until we see a daily close over 100.38, but it looks like we're maybe going to make another run at it, at least the way things are looking this morning.
Yeah, so on page 2, we have that chart of crude oil, and the one thing I wanted to really highlight is just how range-bound crude oil has been in the last 3 months. Going all the way back actually to mid-November, you can define the vast majority of the price action to that narrow range between $74 to $82. And I have the high-volume nodes identified there, which the top end of those ranges are right here at the $78 level. This continues to be the kind of overall trend of the crude oil market, which has been, it's been a big bad bear market in crude, pulling back for much of the year, and then this extended sideways consolidation. One of the key things for me to watch is when will we finally see a pattern of accumulation emerge that is setting in a new trend, and that has not yet emerged. So moving on here to equities. Nick, on page 3 we have that SPX chart. What levels are you watching?
So as I speak right now, the SPX is trading at a spot of 39.50 approximately. Looking out to the March 17th OPEX, which is a monthly OPEX a few weeks away, the expected move is about 130 points in either direction. So the upside from here would be around 40.70, 40.80 or so. The downside would be somewhere around 38.10 or so, 3800, which is also support, heavy support right now. Above us, we have resistance at 4,000, which is a key level. We've been hanging around there for the past week or so. And then beyond that, we have heavy resistance at 4120. But looking at these levels, Eric, I'd be interested in hearing your perspective on the SPX right now.
As I've said several times in the last few weeks, the action at the 200-day moving average should be the tell for what comes next. Just on Wednesday, we got the first daily close below the 200-day moving average, although it was just barely below it. We're now actually a few points below that and hovering right about the 100-day moving average at 39.36, which is about 10 points below the 200-day moving average. This is pretty much the make or break point. We're testing where support should be. If we get a reversal here, it would suggest that we've retested what used to be resistance as support and maybe set for a leg higher. If this breaks down substantially from here, well, maybe it means that this bear market rally is finally over and we're headed for the long-awaited move to new lower lows in this bear market. We'll see what the next few days bring, but I do think in the next few days we'll get a solid indication of one way or the other what's going to happen next.
Yeah, Eric, on page 4, I have that 200-day moving average on there that you were talking about. And we're literally on nice edge here. After several weeks of consistent selling where the S&P 500 is now close to 300 S&P points off of its highs, this is actually a very typical place where a dip should be bought if the bulls are in control of this market. And so as we test this zone right here, it's a make it or break it moment. If for whatever reason the bulls can't turn this off of this key level, and we see a breakdown down towards that 3,900 and then 3,800 like Nick was talking about, then any failed rallies will really put in motion potential breakdowns in the trend, and then substantial selling could be following. The key for here is I'm going to still give the bulls the benefit of the doubt that they're going to be able to bounce this market here, but this is knife's edge, and we're going to see how this plays out. Let's move on here, Nick, to the QQQ and look at these NASDAQ. What levels are you watching going into the OPEX?
The spot right now on QQQ is approximately 288 pre-market, and the expected move for the March 17th OPEX, again, the monthly OPEX, is approximately 13 points up or down from current spot. So upside would be to 305 or so from previous close of yesterday, but from the current level, it would be around 303. And the downside would be to 279 as of yesterday's close, down to 277 as of current spot rate right now. So looking at that box, we see the green box in the chart. That's the range of expected values over the next few weeks. Keep in mind that we have heavy support at 280, and above us, we have broken below that support level of 296 or so. And we have a heavy area of resistance now at 310. And obviously that level of 296 becomes now resistance as well.
Nick, I agree with you. The NASDAQ, though, the interesting observation is on a relative strength basis, it actually continues to hold up better than the S&P. This entire little sequence of selling has still seen the NASDAQ pretty well supported on a relative basis. And that's the interesting thing to me. If one of the things I would have thought if we were moving to a more ominous moment in the markets, that the sector rotation into defensives and out of these kind of high beta names would have been more evident, and that at least up till this moment has not yet materialized. Moving on to page 6, so we have that VIX chart, and what's interesting is that while we did get down into those high teens under the 20 level, overall it really was just noise. There's a bigger consolidation here, and we have neither seen any spikes in volatility premiums nor any breakdown. What do you make of this consolidation?
Yeah, it's been very interesting. Again, I attribute that to the advent of zero DTE options every day of the week, taking away from the longer term volatility purchasing or activity rather. So, the VIX is predicated on the 30 DTE option activity on SPX, and we're seeing less of that now in favor of shorter term duration options. The way I kind of view that is that, if you're hedging in the market, instead of spending, $20 on a hedge, for a month out, you might spend, for example, 50 cents or 80 cents per day for the next month instead, right? But regardless, looking at the VIX right now, spot is 21 or so. So expected move each day is about 1.3, 1.4% or so. And the upside would be to 25. Again, I mentioned this previously that if we break above 25, we're probably going to see a spike higher to around 30, 35, as we've seen numerous times in the past year. But right now, we haven't really seen much volatility intraday. So I don't really see any reason for that to be the case. It could change very fast, but downside would be to 18 or so. Now, moving on to the US dollar on page 7. Eric, has anything changed in your thinking here?
Well, we tested the January 6th high of 105.5, rejecting it so far. Maybe that's the top of a new consolidation range. Looks like maybe we could be setting up for that. We'll see what happens.
Yeah, Eric, the interesting thing for me, we went and tested that January high around 105.5, consolidated here for a week. This morning, we have the dollar once again trying to strengthen towards the top end of this range. That strength is coming from that US dollar yen. The euro is still relatively weak. Whether the dollar manages to break to a higher high here and continue this trend is one of the bigger macro stories to keep watching. So it'll be interesting to see whether or not this continues.
Let's move on to gold on page 8. Eric, what are you thinking of this breakout?
Nice $40 bounce here off of 1812 all the way up to 1852. But I think it's just a reaction to the dollar index pausing for breath and, at least for now, rejecting resistance at 105.5. My bet is that this is not over yet to the downside. There's still several technical levels below the market, layered between 1800 and 1780, and I have resting limit orders on all of them, frankly. I think that this, maybe it could be over already. Maybe the bounce that we've just seen is the beginning of a recovery, but I really don't think that's the case unless the dollar index is topped out, and I kind of doubt that that's the case. But I do think 1780 to 1795 is going to be the sweet spot for where the bottom should come in. And of course, that is assuming that we're not going to see the dollar move to new higher highs above 116. In that case, we'd really be in trouble. And the other noteworthy level is the 61.8 fib retracement down at 1753. A dip down to that level wouldn't surprise me and wouldn't even concern me. And Nomura just had a research note out in the last day or so calling for a 50 basis point hike in March at the next FOMC meeting. If that happens, it might just be the impetus to cause at least a temporary spike down to that 1753 level. So I've got resting limit orders down there too. I am looking at all of these levels as buy the dip opportunities. I don't think that we're going to see rates hiking forever. The Fed will succeed eventually at breaking something, and when they do, rates will come back down, gold will go back up. So it's a question of how far the dip goes. Gold is a famously volatile market, so all the way down to the 61.8 fib retracement before turning back up makes perfect sense. So down to 1753, entirely possible. I think 1780 is likely. 1753 would only be if we get some kind of impetus to push us there.
Yeah, Eric, the part that I'm obviously observing is that gold was incredibly oversold on a short-term basis and was a reaction, even a reaction towards 1900 would be par for the course. The bigger question is there a more meaningful short-term tradable low in on gold? And the jury's out on that for me. I still think that correlation to the inverse correlation to the dollar remains something that's been working very well. And so the next move in the Dixie is going to be pretty important for the next these moves in gold. For me, my levels are also just below this 1800 level. Some in that 1750 to 1800 pocket will be a point of high interest as we move forward. Nonetheless, I want to move on to page 9 here, and where we have the chart of copper. And what we saw was the high of copper came in January, just north of 430, and we've been more or less consolidating since then for about 5-6 weeks. And we've had several attempts for copper to bullishly re-break out, and that just simply hasn't stuck yet. One of the key things for me will remain is whether they can keep copper north of $4 and whether or not we can finally see some of these previous highs being broken and that trend of a potential move to 450 get underway. And so it'll be interesting to see. The last thing I wanted to highlight was on page 10. I have that chart of the U.S. 10-year Treasury Yield, and we were all our eyes were on that December-January high that was near the 390 level, and that's now decisively been broken. We're right now trading right at that round number of 4%, but with this kind of a breakout, the real question is, are we destined to see a retest of those October-November highs in that 425 to 435 zone? And clearly bonds are weak right here, and the question is that maybe contributing to some of the equity weakness that we've been seeing?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.